Why smart investors fail in irrational markets. Retail investing can be an exciting and empowering journey. With the right strategies, knowledge, and discipline, anyone can succeed. But here's a harsh reality. Even the smartest investors, those armed with experience, logical frameworks, and advanced techniques, can and often do fail in irrational markets. If this sounds surprising, stay tuned. This video will explore why even the most astute minds stumble in such markets, reveal the common traps to avoid, and share strategies to help you navigate uncertainty effectively. By the end, you'll have the tools to protect yourself, stay grounded, and even thrive in unpredictable situations where so many investors falter. To understand why smart investors fail, we first need to grasp the concept of an irrational market. Irrational markets are those where price movements and trends don't align with logical fundamentals like a company's earnings, economic indicators, or intrinsic value. Instead, these markets are driven by human emotions, fear, greed, and mass speculation. They arise when large groups of investors make impulsive or speculative decisions, often triggering behaviors like herd mentality and panic selling. Take historical examples like the Dotcom bubble of the late 1990s, the 2008 financial crisis, or the meme stock frenzy of 2020. Whether it was people betting on overhyped tech companies, fleeing stable investments due to financial panic, or pouring savings into speculative stocks, these moments showcase the collective irrationality that overtakes logic. Smart investors often assume markets will behave rationally or self-correct, based on economic fundamentals. But irrational markets can persist far longer than expected. When that happens, even the most skillful plans can unravel. Smart investors are often well-equipped. They study financial data, use time-tested methods like intrinsic value analysis, and rely on logical frameworks to guide their decisions. They research diligently, understand market cycles, and develop strategies based on historical trends. But here's the catch. Being smart or logical isn't enough. In irrational markets, the rules of the game change, exposing even seasoned investors to failure. It's vital to recognize where smart investors go wrong, not because they lack expertise, but because they misjudge how market irrationality can overpower reason. One of the most significant reasons smart investors fail is overconfidence in logic. By nature, smart investors rely on analysis and rational thinking. They look at financial reports, compare assets, and calculate valuations. After careful consideration, they often feel assured their decisions will align with market outcomes. But in irrational markets, crowd sentiment, not logic, often drives price movements. For example, speculative bubbles can inflate stock prices far beyond any reasonable valuation. Smart investors may assume this can't last, prices will correct soon, leading them to take positions that defy the prevailing momentum. What they fail to grasp is that emotions like fear and greed can sustain irrational behavior for much longer than anticipated. And sticking rigidly to logical bets in such markets can result in devastating losses. Another major pitfall is misjudging market timing. Smart investors excel at identifying whether an asset is overvalued or undervalued, but timing when the market will reflect this reality is notoriously difficult. Take the example of value investing. An investor might identify that a company's stock is undervalued, assuming the wider market will eventually realize it too. But if this realization takes months or even years to play out, the investor could sit on dead money or face opportunity costs elsewhere. On the flip side, the same logic holds during bubbles. Betting against an overvalued stock before the bubble burst can be financially painful if the bubble inflates further, as often happens in irrational markets. Even smart investors aren't immune to their emotions. Watching prices soar or crash can shake anyone's confidence, especially in extremely volatile situations. Uncertainty leads to second-guessing. For example, a logical plan might dictate holding on to an undervalued asset during a downturn. However, when everyone else is panic selling, even experienced investors may feel compelled to join the herd. Similarly, euphoric markets create pressure to buy assets beyond their true worth. Seeing others profit sparks a fear of missing out, FOMO, even if the price is unjustifiable. This emotional tug-of-war often leads to impulsive decisions that contradict careful analysis. A classic example of irrational markets, and a glaring reminder of how even smart investors falter, was the dot-com bubble of the late 1990s. During this period, investors poured money into internet-related companies, many of which had little to no earnings or viable business models. Valuations skyrocketed as speculative optimism prevailed. Smart investors who believed in rational principles stood on the sidelines or shorted these stocks, assuming prices would soon collapse. But the bubble persisted, and many rational positions were wiped out before the market finally adjusted. In 2008, the global financial system was strained by a housing market crash, erasing trillions in wealth. Panic consumed markets as investors dumped assets based on fear rather than rational analysis. Even experienced investors were caught off guard by the pace and scale of the crisis. Many logical bets, like holding financial stocks expected to recover, were decimated during the relentless sell-offs. It was a harsh lesson that markets don't behave rationally during periods of widespread fear. More recently, the 2020 frenzy surrounding GameStop and other so-called meme stocks served as another warning against overestimating rational market behavior. What began as a niche movement among retail investors turned into a mass phenomenon that defied fundamentals. Hedge funds and seasoned traders relying on traditional logic shorted these overvalued stocks, expecting them to plummet. But a coordinated push by retail traders sent prices soaring dramatically, forcing massive losses on what seemed like reasonable, calculated positions. While irrational markets can't be avoided, they can be managed. Here are strategies to help you navigate them while safeguarding your portfolio. Flexibility is key. Instead of assuming markets will always behave rationally, adjust your expectations and strategies to account for volatility and unpredictability. Treat irrational markets as temporary storms to be weathered, not predictable systems to conquer. Diversification reduces risk exposure. By spreading investments across various asset classes, sectors, and geographies, you protect yourself from extreme swings in any single area. For instance, if speculative mania overtakes the tech sector, having exposure to bonds, commodities, or other equities can cushion portfolio performance. Acknowledge that no strategy is infallible. Avoid betting heavily on any single position, no matter how confident you feel. Recognizing that uncertainty is part of investing will help you remain cautious in irrational markets. Discipline and emotional control are arguably more important than technical skills during volatile conditions. Create a system that prevents knee-jerk reactions, such as setting predefined stop-loss limits or cooling off periods before making significant decisions. Irrational markets are temporary. Don't let short-term noise derail your long-term goals. Trust in well-diversified, time-tested investment strategies rather than chasing fleeting trends or overly focusing on daily market movements. An emergency fund acts as a buffer and reduces financial pressure during market downturns. By ensuring you don't need to liquidate investments during tough times, you can avoid unnecessary losses. Before entering any position, set clear boundaries for risk tolerance, exit points, and overall exposure. Having these rules established ahead of time helps you stick to your plan, even in irrational markets. Beyond technical and fundamental analysis, pay attention to psychological factors driving market behavior. Understanding crowd sentiment can provide context for movements that seem baffling at first glance. Dollar-cost averaging allows you to invest consistently over time, reducing the impact of market volatility. It ensures you're not overly exposed to market highs or lows, providing stability through unpredictable periods. The takeaway from all this is simple but profound. Being a smart investor isn't always enough to succeed in irrational markets. Relying solely on logic can lead to overconfidence and misjudgment. Instead, adaptability, emotional resilience, and long-term thinking are just as critical to navigating unpredictable market behavior. While the markets may sometimes seem like a battleground of chaos, you can thrive by staying disciplined, diversifying your investments, and focusing on your ultimate financial goals. Have you experienced irrational market behavior firsthand? Share your lessons in the comments below. We'd love to hear your story. If you're finding our content valuable, hit the subscribe button and stay connected for more educational videos to help you navigate the world of retail investing. Remember, markets may not always be rational, but with the right mindset, you can avoid the traps, seize opportunities, and build a brighter financial future.